A different topic, I think that's useful and important to know. Wonderful speaker, wonderful person.
Being in the trenches, I was sort of witnessing what was going on in capital markets.
So hello, friends. Thanks again for joining us. This is Steve Taylor, the lead advisor over here at Merited Wealth, and you are joining us for another episode of the Do It For Yourself podcast. And today's episode is going to be a little bit different. If you're the first time you're joining us, we typically will have conversations about the challenges and opportunities presented to small business owners and bring in some different subject matter experts in that area. But what's going on in the world right now, I thought it was so important to bring in someone, really an expert, to talk about a different topic. I think that's useful and important to know and really blends into a lot of the other stuff that we do and should be concerned about. And that is really, a lot of the things out there in the discussions around the bill. The big, beautiful bill is trying to go through it and may have gone through by the time we air this podcast. But the repercussions of this deficit spending that our country's been in for a very long time, right? And really, I got a speaker, a wonderful person here. Paul, give us a little introduction. Let everyone know who you are.
Yeah, thank you, Steve. So I was a professional investor most of my career. I've managed mutual funds up in the Toronto area. And yeah, I loved my career. I had a lot of fun doing it. But my main passion over the years became communication. And so my clients are, as you know, the industry, financial advisors. But then over the years, I found that I was sort of tripping myself up. I'd be contradicting myself. A client would say, but Paul, last year you said this. That sounds different from what you're saying now. And I was thinking to myself, you're right. And, because I was just trying to get the sale. I wasn't lying, but I would sort of leave stuff out. And it was getting really embarrassing. And so I said, I'm not doing that anymore. I'm just going to be blatantly honest with people about who I am, what I do, what I cannot do in different market environments. Nobody knows what's going to happen in the future, but in all these different environments, here's what our funds will do. Is this something that you think you and your clients would be comfortable with? Yes, that sounds good. That's a great outcome. Or no, the money, but it's a good outcome for that client and their clients, because if we end up doing something that they don't expect, they'll probably take the money out, and you know how it is. They take it out just at the wrong time.
Yeah.
And so over the years, that communication, trying to put myself in other people's shoes, how can they best understand what I'm trying to tell them? And then I started using analogies. I had all kinds of analogies that I would use. And then my clients would use those analogies with their clients. And then I'd write my quarterly reports. And then we can get into it, but, being in the trenches, I was sort of witnessing what was going on in capital markets and how asset prices were being distorted, price discovery mechanism of capital markets being distorted in order to drive asset prices higher at all costs. And it was just very, very frustrating watching this happen year after year, because that comes at the real expense of the economy.
Yeah.
So central banks, policymakers, all with good intentions, but they sacrifice economic productivity growth on the altar of asset price inflation, thinking that at some point down the road, all the benefits of this will trickle down to everybody else. Well, they haven't, and they won't. It's a small percentage that really benefit. Homeowners benefit, and we can talk about that and why we shouldn't be. But yeah, so just getting frustrated that this was happening, and it was happening because so many people, including a lot of politicians who most are not economists, don't understand how an economy really works. And so I decided to write a book. And so I started in 2019. So I just finished. It took me 6 years. And it explains step by step, easy to understand terms, what's going on. And the idea is to empower people. You don't have to be in the finance industry to understand this book. Empower people to demand the right actions from our policymakers. And they will do it, right? The policymakers are good people, but they're only going to do the right thing if we demand it. And right for the last 20, 30 years, we've been demanding that they do something else. And so they have accommodated our demands. So the book has been released in the UK, and you can pre-order it on Amazon. So in North America, it'll be released on July 1st, whatever. So that's what I do. I have a blog as well. And
that sounds great, Paul. I know I love it. So much in that little intro there, just talking about a great lesson for people, like who you are and what you're doing. And I think many of us in our career arc and our career trajectory, we understand and we get pushed to sell, and then we want something different. And we understand that's not necessarily helping people. And if we sell people in this certain way, may not even want them as clients, but that's a whole different, podcast there. But so let's Paul, let's go back, when we're talking about this, this big beautiful bill, right, has come about, and the county has come back and said, hey, listen, we think this is going to add potentially around 3 trillion plus to our federal deficit. As you've been, your careers, spanned all this different time, and correct me if I'm wrong, I think the last balanced budget we had was under Clinton, right? And the economy was looking good, and deficit really wasn't that bad. And what do you see? What's happening? And you mentioned towards like asset inflation and the like over the last couple of decades. How did this problem become to where it is now, to where we have this massive federal deficit? And what was kind of the mindset that was happening and switched, whether 2 or 3 decades ago, to say, hey, we think it's going to be okay to these deficits?
Yeah. So, it's a long journey, obviously. It's like one of the greatest economists of all time was Ludwig von Mises. He's viewed as the king of the Austrian school of economics. His main book is called Human Action, right? So it's about people. And because it's a social science, there are different theories within economics or different schools of thought. And so you might have Keynesians, you have the Austrian school. Now you've got modern monetary theory, you've got monetarists, and they have different views with respect to what drives an economy forward. Excuse me. And so because there's these different schools, some are more for fiscal discipline and it's about the hazards of living beyond your means, and that it's saving and investment that drives an economy forward. And then you'll have other schools that will say, no, it's consumption that drives an economy forward. And so debt-fueled consumption is good for the economy, and deficits don't matter as long as we're a monetary sovereign. We can print our own money to pay off that debt. It matters a lot. And you can imagine that politicians, because most of them are not economists, they're going to gravitate towards the school of thought that tells them that they should borrow, that they should print. And so this has really it's been an issue, but it is really accelerated. There were 2 sort of watershed moments. The first one was 1971, and that's when President Nixon took the U.S. off of the gold standard, and it was the dawn of the fiat currency era, which then made it very easy for central bank or the Federal Reserve to increase the money supply. Like their sort of handcuffs were off. And that's why you had that rampant inflation during the 1970s, or stagflation, where you had rising inflation and rising unemployment. And it took Paul Volcker, the greatest central banker of all time, who was willing to do the tough but right thing. He took interest rates up to 20%. Can you imagine? And it killed inflation, but it also resulted in 2 very tough recessions in the early 80s. And people were complaining and marching on Washington, all this kind of stuff. But that then set the stage for the next 20 years of really strong growth in America, strong productivity growth. To your point, even had balanced budgets with Clinton. I think it was 3 years of balanced budgets in the late 90s. It's also almost seems unimaginable now. And so that was good. But then, we had that dot-com bubble. There was a lot of good stuff going on, but a lot of it was overpriced, as you know. But that was leading a wealth effect where people's stock portfolios were going up in value. People feel wealthier in large part because they borrow money on the higher collateral values of their equities and go and spend it, and that boosts GDP. Now, all GDP is a measure of final spending, and most final spending is consumption. That's why so many economists think that consumption is what drives economic growth. It's saving and investment, which then allows you to consume. We could talk about that if you're a little bit later. Anyways, so driving are the equity prices going higher, wealth effect, good for the economy. Dot-com crashes, and then there was a negative wealth effect. And so there were market commentators like Paul McCulley from PIMCO and Paul Krugman, who writes or used to write for the New York Times. They recommended that the Federal Reserve should create a new wealth effect through housing. Drive housing higher so people feel wealthier, then they will extract equity from their homes and spend it, and that final spending will boost GDP. I think it was, despite the fact that the economy was not in recession. Right? There was a very mild recession in 2001. It was only 1 quarter of contraction. Regardless, they kept rates on the floor because they were trying to drive housing prices higher. People were extracting hundreds of billions of dollars from their homes and spending it, and it was driving GDP growth. And that, to me, that was really the beginning of the end of what we'd had. We just come from balanced budgets. And now central banks are distorting asset prices and convincing everybody that debt doesn't matter, that fiscal deficits don't matter, that we need inflation for an economy to grow. We don't. Nothing could be further from the truth. And we can talk about that as well if you're interested. And then, of course, driving housing prices higher in the subprime crisis, they blew the whole thing up. And then rather than say, well, maybe we shouldn't have done that. Maybe we should not have distorted housing prices from levels that were different than market forces would dictate. And so they doubled down with quantitative easing. Printing trillions of dollars was explicitly designed to drive asset prices higher. So the Federal Reserve buying trillions of government bonds, which through the portfolio effect trickles through other asset prices, eventually driving equity prices higher. And the Fed it's not a conspiracy. The Fed will tell you this is what they were trying to do. And so then you have ballooning government debt because the central banks now are buying all the government debt, keeping interest rates extremely low, encouraging more and more debt-fueled consumption, more and more entitlement spending, such that you get, and everybody is benefiting because they're all getting money. Our housing prices are going higher, our equity is going, it feels really good until you get to the point where you're bankrupt. And one specific example was in France in 1983. The then president, Francois Mitterrand, he lowered the retirement age from 65 to 60. And so everybody loved it. Wow, I get to retire 5 years earlier. And look, there are no consequences to the economy. So not only is Mitterrand a nice guy, he's an economic genius. Well, guess what? The consequences are 20 years down the road, and the bill has to be paid by the next generation because you allowed the previous generation to take more out of the system than they put in, right? So it's the consequences are often far removed from the initial actions.
And that allows the politicians to come in and kick the bucket down the road. And like you say, I think that's I have read about modern monetary theory and saying deficits don't matter. It's all about demand and going back. But I've met it with skepticism as you would as well. So let's get that background. That's really educational and showing us what happened and where that trend changed. So now as we see, that we're looking at this bill, right, and it's saying that the tax cuts with the spending are going to create, more deficit. What are the other levers to potentially pull, or where thought as to try to reverse this? Is it as simple as driving revenue and cutting expenses, or you mentioned also keeping interest rates low to drive up asset prices? Is it the theory that, like you say, Volcker did in the late 80s, raise interest rates, create some pain, we go into recession, but that's okay, and assets go, and that gets us there. Where would you say, to give, as people read this top line, where would you say would be a prudent first area to start focusing on to try to start reversing this trend of what happened in the turn of the century?
Yeah, no, it's a great question. So in my book, I have sort of these 10 steps that I would advise that we take in order to start the healing process and make the economy more fair, because it's not fair right now. And the first step, and it's one of the most difficult ones, is allowing interest rates to be determined by market forces who have skin in the game. So the interest rates, I think as Jim Grant talks about, the interest rate being the most important price in the economy. And that most important price has been distorted far below its natural rate. Like central banks don't distort it higher than the natural rate. The only one who's ever done so was Paul Volcker. And so you have in the economy what's called the natural rate of interest is determined by millions of people making risk-return decisions with their capital, with their skin in the game. And so you're very careful about how you allocate your capital. And this then results in a natural rate of interest. And then on top of that, you would add people's, like a risk preference, and there would be a term premium and stuff like that. And so if you allow the natural rate of interest to form in the marketplace, then it would be probably higher than it is today. And
that's fascinating, Paul. If I could ask you to touch on that, I've not that said before, but that's really fascinating because I see a lot of people at the natural rate of interest, right? There are businesses, there are individuals who don't go to banks for their loans for whatever reason. They don't go to banks and they do this private lending. And so I have clients that are in that business, right? And the private lending rates, I would say, and once again, it's risk-based as you mentioned, but I see those rates anywhere from like currently like 9 to 11%. I mean, does that feel like if a central banks weren't involved, that's where the natural interest rate might look, or is that a little high?
Yeah, that might be a little high, but it depends on is borrowing the money for how long they want to borrow it, right?
Right.
But people will are blaming sort of housing unaffordability right now, particularly here in Canada and places like Australia. They're blaming it on high interest rates, high mortgage rates. So the 30-year mortgage rate in the U.S. right now is something like 6.85% or something like that.
Yep.
That's actually below historical standards. So if you look back and, the average over, I don't know, last 40, 50 years has been like 8 to 9%. Now, that included the very high interest rates of the Paul Volcker era when he took interest rates up to 20%. And so people say, well, that's only because of that small, short. No, it's not. So if you exclude the high interest rates and you exclude the zero interest rates of the Ben Bernanke era, the average mortgage 30-year rate in the States was about 8% or just over 8%, right? So the issue with the housing affordability is not high mortgage rates. They're still slightly below long-term averages. The housing affordability crisis is a result of central banks driving housing prices higher and taking them out of range for the income. Like in parts of Canada, the median income can't come anywhere close to affording the median house.
Right.
But back to your earlier question about, so that would be the first step, is allow interest rates to be naturally determined. The second would be to stop rapidly increasing the money. And so the way an economy should work is that in a capitalist free market system, whatever you earn, whatever you have in terms of material wealth should be a reflection of what your contributions were to society, what you created. So the example I like to use is you make a suit, I make a bike. We both created capital, right? And then we exchange that capital with each other. Now I've got a suit, you got a bike. And importantly, that didn't come at the expense of anybody else, right? The suit that I now have is a reflection of the fact that I created a bike, right? I created capital and then I exchanged it with you. Now we don't do a direct exchange, so there's a barter system. We have an indirect exchange economy. So I will then sell my bike for money, and I will use my money then to go buy a suit from you. So indirect exchange. Now let's say, so it's capital that makes the world go round. It's people producing capital, either in the form of a good or a service, that makes the world go round. It's not money. Money is very important, but money is only there to exchange all the capital that the people are producing. And this is where the trouble starts, when you start to store your capital up in money. So let's say you make 10 suits and you sell them for $1,000 each, nice suits. And then, so now you've got $10,000 in your bank account. What that $10,000 represents is the 10 suits that you produced. Your capital, 10 suits, is stored up in that $10,000 in your bank account, right? That's your means of payment. The money is just the medium of exchange, how you exchange the capital. So you got $10,000 in your bank account. You don't want to spend it right away. You're saving it for a vacation at the end of the year. Now, before you get to go on your vacation and spend your money, but when the central bank doubles the money supply, they print money out of nothing, right? But they print it out of nothing. And so they didn't create any capital to obtain that new money. So that new money has no capital stored up in it. It only gets capital once it comes into circulation. And the way it gets its capital is by extracting capital from the rest of the money already in existence. So when they double the money supply, it extracts half of the suits that you've got in your $10,000 and puts it into the newly created money.
Yeah.
So you still have $10,000 in your bank account, but instead of storing 10 suits, now it only stores 5 suits. And therefore, your $10,000 will only buy half as much as it would have before the central bank doubled the money supply. So Absolutely. It's a hidden tax, they call it. The government doesn't produce any capital. The government can only access capital from the private sector. And it does it in 3 ways. Taxation, of course. It can borrow from the private sector. And the third way is by printing money and extracting capital from the rest of the money already in existence without your permission.
Very interesting,
In
Paul.
some ways, without your knowledge. And that's why actually the title of my book is called Capital Offense. That's why it's called that. So why some capital offense, why some benefit at your expense. So interest rates, market determined, stop rapidly increasing the money supply. Those are sort of the first two and most important steps to setting us on a path of, productivity growth, lower debt levels, balanced budgets, and a more fair distribution of the wealth that's being created.
That's great guidance, Paul. I really appreciate that. So my money would come to, and that's great to understand what the central banks do and what the government can do. So now we're, a lot of these people, when they're hearing about deficits, they're seeing about bills, right? It's not, one side is the taxes are raised or lower, and the other is a government spending, right? We'll call them certain entitlements, right? These for the, we'll call it, the less wealthy, the needy, the disabled, the poor, right? Lots of countries have that. How do you, in that situation when you're trying to get this balance and you have those programs, right, to try to fund those, what is, so when people are seeing here, like, hey, what can I do to help out, this scenario, or maybe whether, where it's maybe pay down my own debt, right, and help, money supply in that way. What is the solution then when we're trying to do this reversal and the government entitled spending? Is it simply to lower the amount of spending or create other pathways for that become the viable? I mean, I know Canada has the big issue with socialized medicine, that as well. For those that are out there and saying, okay, well, we have to do deficits because we have to spend on these programs. What would your thoughts be on what's another way to solve that and create a solution there?
Yeah. So again, there are no easy answers. And the economist Thomas Sowell said, there are no solutions. There are just trade-offs, right? And so it's a combination of a number of things. I think step one is helping people to understand what's going on and understand that there is no such thing as a free lunch.
Yeah.
And that your benefit is coming at somebody else's expense, right? And most people don't realize that their benefit is coming at somebody else's expense. And so it's very easy to not demand change because you think, well, I've earned this, and to a large extent you have, but to some extent you haven't. And so if we look at Social Security, for instance, I think on the current path that we're on, it will, in the U.S., it'll be insolvent by 2035.
How about Medicaid, Paul? That's the topic out there right now. Medicaid cuts, right? That's really, I think, a part of, I don't know if it's a Big Beautiful Bill or another bill. They're saying cutting that is for the medical, for those that need it. Yeah,
I'm not as familiar with the details on Medicaid, but what I will say is that, we can't be punishing lower income people either. In terms of how much costs are, how much either pharmaceutical companies charge or whatever. I mean, it's a tough one in medicine because, yes, drugs are more expensive in the U.S. than any country in the world, yet more drug discoveries happen in the U.S. than anywhere else, for that very reason.
Yeah.
The U.S. leads the way with all these incredible, not just in medicine, but, knowing exactly or trying to figure out or trying to strike that balance between encouraging that innovation through the profit motive and not having all that medicine be unaffordable, such that people can't even afford to buy it. You have to go into trillions of dollars of debt just to allow people, which has consequences. It's a one.
Yeah.
But in terms of like Social Security, which is, as I said, it's going insolvent by 2035 unless there is change.
Yeah.
I think it's got to be a combination of, and one of the issues is earlier we're talking about when you're managing expectations. Governments have managed people's expectations. Here's how much you're going to receive in Social Security. But again, it doesn't come from the government. It comes from other taxpayers. And it's always much harder to take that away from people than it is to not give it to them in the first place. And it's not binary. It's not like all or nothing. Well, maybe it's not quite as much as you thought, or maybe you don't index it to inflation to the same degrees you did before. Maybe we just start increasing the age people receive Social Security by 6 months, or maybe by a year. Start increasing the contributions that people and corporations will make into Social Security. And then if you have an unhampered price discovery mechanism in capital markets, productivity growth will start to grow again, and there will be more wealth being created. So you do a little bit on the productivity side, and then over time, I think you can get there. We're not going to get there overnight. One other thing that I would recommend as well for the U.S., the Social Security have to buy U.S. treasuries. That's not an investment. So when Social Security buys U.S. treasuries, the U.S. government takes that money. They don't invest it. They don't put it to productive use such that when the bonds mature, if it's a 10-year treasury, 10 years time, oh, we got all this capital, we invested that money, now we can pay the bond back and we have a little bit extra. No, it's spent.
Yeah.
Right? And so when
circular.
the government has to pay that 10-year treasury back in 10 years' time, it doesn't have this pot of capital. It then has to go and tax people 10 years from today. So there's like a future liability that is not being sort of accounted for. It's not an investment. That in Canada, our pension plan is actually invests in equities and stuff like that. So it is a separate pool of capital.
That's really interesting, Paul. Yeah, I know about that. I honestly did, and I'll look at that. You're probably, spot on, and that's why this current administration is maybe talking about these different sovereign funds and different asset classes to be able to invest in. That makes a little more sense, understanding where it's being to invest. So, one last question I'd have for you, regarding, and the ability of the U.S. and the politicians to take on more debt. We have very recently Moody downgrading the U.S. debt, right, and then to make it less attractive. Is there would you foresee a future, right, and then these continuing downgrades in that the government won't be able to just keep issuing debt? People are going to say, hey, I've had enough. You guys don't kind of have your act together. That would be a mechanism to kind of force this change, or does there seem to be that even though we're hearing about these downgrades, there's still an endless supply of buyers?
Yeah. So I think you're referring to the bond vigilantes who will all of a sudden refuse to buy your government debt because you're taking on so much debt, such deficit spending that then investors in those bonds will worry that the government will resort to the only way possible of paying back those bonds, and that is through what they call financial repression, where you force interest rates down and you explode the money supply higher. And so if you've got a financial institution or a hedge fund, you buy $1 billion of U.S. treasuries, 10-year treasuries. In 10 years' time, because the U.S. government can print its own money, they'll pay you $10,000 back. But just like your $10,000 had 5 of the suits extracted from it, that $10,000 10 years hence will buy a lot less than it can buy today. So they inflate away their problems. And so the hedge fund will then say, well, I know you're going to print money in order to pay me back, and that's going to result in inflation. So I want a much higher interest rate before I'll lend you the money. And then interest rates start going up. And then every time the U.S. government has to roll over its maturing debt, the interest expense goes up and it blows up the budget. So in the U.S., interest expense on the debt, I think it's around $1 trillion now. It's more than defense spending.
Yeah.
And there are some out there who think that once a country gets to the point where the interest on their debt costs more than they spend on defense, it's the beginning of the end. Yeah. I don't think it is. I think that we're all going to solve this. I do, but there are no easy paths. So we can either all decide together that we are going to change for the better and we're all going to share in the pain and do our part, or hope that somebody else will bear all the costs and don't change. And that will result, I believe, in an out of control explosion, which would be far worse. And people will misdiagnose what the real issues were. And so then they will then prescribe the wrong medicine, which, believe it or not, will be even worse than what we have today.
Well, Paul, I'm gonna leave us off there with that hint of optimism, and I'm going to agree with you. We're going to figure it out, and it all starts with an honest and open conversation, like one that we're having right here. And hopefully, the politicians will get that sooner than later, and we're on the path to kind of figuring this out. But Paul, listen, I really appreciate your time. For those listening that find it interesting, we're going to have links to your books and all your writings, your blog, and everything in this podcast. Okay. I found this very, educational, as that's your new goal to meet that. I've really enjoyed our time here, and I for your talk.
Well, Steve, it's great to meet you, and thanks so much for having me on. I really appreciate it.